What if I told you the richest people on earth don't avoid debt, they depend on it? While middle-class families fear loans, billionaires engineered their entire empires around borrowed money. Debt made John D. Rockefeller unstoppable. Debt lets Elon Musk live tax-efficiently. Debt helps billionaires buy companies without risking their own money. So the real question isn't, is debt dangerous? The real question is, why does debt destroy the poor, but multiply the rich? Let's break this down properly. Debt didn't start with Silicon Valley. It powered the oil age. In the late 1800s, a farmer's son named John D. Rockefeller built what became Standard Oil, controlling nearly 90% of U.S. oil refining. But here's what most people miss. Rockefeller didn't grow by saving money. He grew by borrowing strategically. His first loan? $1,000 from his father? That loan allowed him to enter commodity trading. Within 2 years, he was generating serious profits. But the real shift happened when he understood leverage. He borrowed to acquire competitors' scale operations, negotiate better railroad shipping rates. Production costs. Debt allowed him to move faster than everyone else. But here's the difference. He always borrowed for expansion, never for consumption. He didn't borrow to look rich. He borrowed to become rich. He always paid lenders back on time, which meant future borrowing became cheaper and easier. That's the first pattern. The rich use debt to buy income-producing assets. The poor use debt to buy depreciating liabilities. That difference changes everything. Most people think wealth comes from salary. It's financially naive. The ultra-wealthy don't depend on salaries. They depend on assets. Take Elon Musk. He has repeatedly stated that he doesn't rely on a traditional salary. His wealth is tied up in stock. So how does he fund his lifestyle without selling shares? He borrows against them. It's called asset-backed lending. Instead of selling stock and triggering capital gains tax, he uses shares as collateral to get loans. Why does this matter? Because borrowed money is not income. Income is what gets taxed. If he sells stock, he pays tax. If he borrows against stock, he doesn't. As long as his assets grow faster than the interest rate, the math works. But let us be honest. This strategy only works if your assets are extremely stable and appreciating. If markets crash, lenders can demand more collateral. That's risk. But the wealthy accept controlled risk for strategic advantage. Now let's talk about real estate, the playground of leverage. The average person buys one house with a mortgage and struggles for 30 years. The wealthy use debt to buy multiple properties even when they could pay cash. Why? Because cash is opportunity. If you lock $1 million into one house, that money is stuck.